Welcome to Markets Now. I'm Michelle Rook along with John Payne with Hedge Global Markets, and we're seeing mostly lower prices, except hogs have rebound after setting contract lows, and some of those back months in the feeders are trading a little bit higher. Some of the pressure this morning, though, in the grains, John, looked like a little bit of risk off from some of the outside markets and whatnot.
Yeah, I think the weather in the shorter term looks better. Some of the forecast models this morning that come out right around 6 a.m. Central Time is when you'll see the a whole host of them come out, and they came out with a little bit of a weather forecast out and extending rains into the western part of Kansas. So at this point, if you're trading wheat, especially Kansas City, you're really trading forecasts here. One or two good rains, I think the crop could certainly bounce back and make a decent number. Not trend yield, but I think something better than maybe the market is priced in here. Plus, you have the fact that the Kansas City is so expensive. So, in our opinion, you have one of two things are going to happen. You're going to see KC stay strong, and the rest of the wheat belt and the global wheat prices come higher, or eventually you'll see Kansas City fall apart here if it does rain. If it doesn't rain, the crop could be one of the worst we've seen in recent memory.
Yeah. Although when we look at new crop corn and soybeans, we're going to have to respect this weather forecast a little bit there, don't you think, here in terms of planting progress, and especially up in the north?
I think so. And I think you also have the areas that are dry, that were dry last fall. And I'm really thinking Nebraska they're still really battling it. And, the issues right now are, getting out, even doing field work. And I've heard a lot of problems up in, north central Nebraska, some of those areas that, are kind of on the irrigation border there. I think at this point, from the end user standpoint, and I wrote these prices down before where I came, that's kind of the perspective where I try to think. And you have December trading, or I'm sorry, March of 24 trading 575. You have December of 24 trading 546. So new crop of next year trading 546, and then 499 for the following year. So we've got a steep inversion here with May leading the way. I think the no-brainer, and it's easy decision to tell somebody to sell corn. Look at the structure, look at the carry here. But that inversion, especially given the weather out west where the basis is so strong, I think it's a tough sell. And I actually encourage some of the guys I work with on the end user side to try to step in here and buy some, just given the uncertainty that can come down the road from both Brazil getting their corn out to the global market, as well as what's going to be grown in the United States.
And while that's good advice, John, the cash market has been doing a lot of the heavy lifting anyways, hasn't it? Basis level still very tight in a lot of those areas for corn and beans.
Absolutely. And I mean, again, going out west, you look at where the basis, if you've been smart in HT8 and kind of rolled your basis over time, you might be selling $8 corn here because the basis appreciation you're going to get for rolling is so far worked out. You kind of wonder here, one correlation to the last 3 or 4 years that has not hit yet would be that once you see Brazil kind of assume their crop is made, and I don't know if we're quite there yet, but we're getting closer to a point where you can start to look down the weather and say, all right, well, they're going to do okay. You tend to see the Brazilians come in and take U.S. market shares. The late summer bids start to come in here on the overseas markets. We're not seeing that happen yet, and in fact, you've seen the spread even widen as we've gone into what I think has been a pretty good start to the Brazilian season. So that's bullish basis. I think the basis in general is a strong point for the farmer, and I think it shows kind of the financial strength that the U.S. farmer and the producers are sitting on right now. Because I think it's the merchandisers who are really going to get squeezed here, and that's where for me, looking to advise somebody on the buy side, if you have the ability to access the credit markets and buy ahead, I think it's something you should take advantage of, because not every buyer can do that. This is not 2019, 2020, even last year, where you could go out and buy ahead and your merchandisers would be okay with that kind of risk being on their books. Right now, it's so expensive to hold those trades that a lot of folks aren't allowing it.
So that strong demand is holding up the front end of the board. Like you say, we have these inversions in the market, but how long can the front end of the board hold up even new crop corn and soybeans for this marketing year, do you think? I mean, because we kind of went down, tested support at $13 on November beans, around $5.50 on corn. We held those areas, but how long did they hold?
I think the bean want to hold for a little while. I think the bean number, and especially given the Argentinian situation, it's a disaster. And Brazil, I mean, Argentina tends to be an exporter of soybeans. They're having to import. which is amazing. So at this point, I think the new crop beans for the United States, we're going to need to pull some acres here. If we go into the ground with 87.5 and you do a 51 instead of a 52, you're really talking about 2007, 2008 type rationing levels that'll be needed. So at this point, I think the job of the market for the beans is to pull acreage from corn. Corn can kind of do that on its own by falling in price, but so far we've seen specifically that December and March contract I mentioned really do okay. And I think they're going to give some opportunities to give folks a decision up around $5.80 to $6. I think to get beyond that, we're going to need to confirm problems elsewhere. At this point, that's really not the case.
Yeah. So let's talk about live cattle futures. We are seeing a little bit of pressure here as we move through the mid-session. So is that profit taking, hedge pressure, or maybe just a little bit of a turn ahead of the cattle on feed report? Plus, I know boxes at noon were just a little bit lower, but is this healthy, I guess?
I think it's healthy as it's been. I mean, it's really, if you haven't had a chance really to get into this cattle rally but a couple of days. So it's tough, I think, for a lot of folks to want to buy and chase up here. I know it doesn't pencil very well, especially the longer dated feeder cattle. So we track profit margins for a lot of these folks. So on the feedlot margins, just in the middle part of March, they were trading $680 a head. Then they went all the way up to $730 a head just a couple days ago, and now have fallen apart as the back end fat cattle markets have fallen. So at this point, it's a mystery to me as far as what's going to keep the cash higher, the beef higher. That is a concern I have. It's not about cattle or feeders or live cattle or feeders to me. I think it comes from the beef. We have an $80 hog carcass right now. Chicken prices have really fallen. Turkey prices have really fallen. You talk about the egg collapse we've seen. Beef stays strong. We're north of $300 choice, which, I mean, the spreads between pork and beef right now aren't as high as they were in 2014, but the ratios are massively wide. The spreads are massively wide. And even as somebody like my wife and I shop at the grocery store and go to the retail, she's starting to notice bacon that she paid $10 for last summer. She's now paying $3.50 for. Meanwhile, you have ground beef trading for $9. So I can buy 3 packs of beef for one thing of ground beef, 1 pound of ground beef. And that's a trade I think a lot of the food service of the world will be willing to make here. So I'm a little more bullish on the bellies. I'm bullish on the pork, whereas I'm a little more bearish on the beef. So I guess take that as far as the cattle and the hogs go. I think we're so extremely wide. It kind of indicates to me that somebody's blowing out here.
Right. And you've had a lot of those cattle hog spreads, long cattle, short hog spreads going on here, and they have continued to push that. In fact, hogs hit new contract lows again here today before we saw a little short covering bounce, and the funds are a record short there. So have we just gotten hogs to a price point now where we're just too cheap? Is that what's happening?
Well, I don't know about the front months, and that's what we're seeing here. I think the bets now are being made that the cash is going to stay lower for longer. I get to read a lot of, I guess we'll call it smart analysis. And these are folks who don't really have a trading opinion, more just trying to estimate where they think the different cuts will be through the summer. And they've been dead wrong. They thought, we'd see 120 bellies by now, and we're seeing $75 to $80 bellies. So, I think there's been a lot of in the trade here, especially on the hog side, where people have been like, oh, what do I do here? I missed the hedging point. It's like everybody missed the hedging point. Selling hogs after Easter, between Easter and Memorial Day, has not been a profitable strategy going back to a long time. At least, I've been doing this for 16 years, and it's not something we really ever have seen employed. And it really worked out this year. So we'll see if it holds into the delivery. I think the longer the cash trades sideways, July is the one I'm concerned about now, trading north of 90 this morning. That kind of bleeds down into the mid 80s. Then October does the same. Then you look at August does the same. Then you look at October trading, even in the 80s here, that could go to 65. So those are all really bearish prognostications. I think the funds have certainly priced a lot of that in, and I wouldn't recommend anybody jumping in emotionally here and selling hogs. But it's a cash market that needs to turn from the pork side.
Right. It hasn't really bottomed. That's been a problem. Obviously, you talk about the premium the futures are holding to that cash index is problematic here. But we're at a level where some of these guys are not making money. And so this is going to effectively stop any expansion efforts, isn't it?
Oh, absolutely. And I think the trade to look at is the deferreds, the July 24, June 24. You can get that. there's a lot of different techniques you can use, but you probably get an accumulator on that sub 86, maybe $86. If you are willing to risk some things, specifically longer term. I think in the near term, it's that's where the value is. And this, I was saying this to a friend of mine today. This hog market reminds me of cotton from 3 years ago, 4 years ago, where cotton went from like 65, where it was cheap, all the way down into the 50s, and everybody just kind of froze at that point. And then it was like a summer later, we were trading $1.40. Now, my advice for people who are new to this is don't just look at the front month, look at the back months. The deferred, specifically in those summers of 24, I think can offer a lot of value, because we can assume the behavior here at $6 corn for next year. Like, there's no expansion. Soybean meal and north of 400, there's no expansion there. So if the market needs it, and there's assumptions at some point it will, that's how the market will rebound.
Cotton, do you think that market's going to continue to hold together? We got good China GDP numbers yesterday, and I know that's a big key for that market.
I do. I think that as the world consumer comes back online, cotton should perform a little better. I think at this point, farmers, the producer side of it is it's like a no-brainer. You're going to plant something else. We need to have some sort of substitution come down to, or come up to give it a better factor. But I do think in the very short term, you're exposing yourself to a lot of emerging market commentary type of trades that can happen. So you got to be careful here. I think that market, the July is one I would not chase. I just think the economic problems that the world could face in the near term, banking crises are going to continue to happen here. We're kind of through the first one with SVB, but there will be others. We've got the ability to handle them, but I think it's these higher rate environments are going to be difficult to hold long term.
All right. Thanks so much for joining us, John Payne with Hedge Point Global Markets with Markets Now.